All right, team, we are live. And mortgage rates have dropped 2 days in a row. I don't know what's going on with Barry Abib and the MBS Highway site, but it has been down since yesterday. So we've kind of moved over to Mortgage News Daily here to get some information on rates. But essentially, we'll look at bonds here in a second. They have a cool interactive chart that's through TradingView, which is really nice. So we'll look at rates here in a second. I'm not going to pull up specific rates today, but I will do that this week. But we'll look at bonds. We'll see the trend. Rates have been going up, obviously. It's been a huge deal. There's a ton of stories to discuss today. I'm going to kind of rifle through all this stuff and just kind of let people know, the market has become more friendly to buyers, but it's still multiple offers. We're still getting a lot of no's out there. So, yes, million miles away from a crash or anything like that people have been talking about. I've told you not to worry about that, but there is a shift in sentiment. You're seeing, listing agents are calling you back and going, "Hey, were you guys going to put an offer? You were going to put an offer, right?" We haven't had a lot of that going on, and so it's nice to finally be wanted again as a buyer, but still getting a lot of no's out there. So Derrick Evans here, NMLS 155010. Call, shoot me a text, and email if you want to buy or refi.
Check, please.
And let's get to it. Let me get myself out of here. Let's get this out of here. Okay. So rates. This is my first time using this site, so give me a second. It's weird. I'm so used to MBS Highway, but this is TradingView. This is the 4.5% bond here, and you can see that we have definitely been in all kinds of a downtrend here. It hasn't been pretty, but the last couple days, and this happened right after. Can I zoom in here? Let me zoom in. We got this formation, and I know I didn't do a video, so you have to take my word for it, but this is inverted hammer right here. That's what this guy is right here. And that can be seen a lot of times as a reversal candle. So we saw that. It was like, oh, hey, interesting. Inverted hammer at what looks like might be a bottom. And we've been talking about how could the worst be behind us? CPI comes out tomorrow, by the way. For everyone who's not paying attention, Consumer Price Index, this is happening tomorrow. These readings are going to be huge because rates will drop once inflation tames down a bit. Not just immediately on the first report, but as we start to see month over month inflation easing, which probably isn't going to happen just yet, but that's what we need to be looking for. That's going to change the whole macro sentiment. The market maker sentiment will change at that time. Yesterday we had a great day, huge gain. I don't have an easy way to do this, so I have to do it manually. 100.8 to, so we had 60 basis points yesterday. And then today, from 40 to 67, we're up 27 basis points. So here we are in great shape, running into an area that's going to have some resistance. But we broke the downtrend. There's a downtrend line here that was going like this that we broke today. Today was the day we broke it. So that's huge for mortgage bonds, for interest rates. This looks good. This looks really good. Obviously, tomorrow the report we could just sink right back into here and be underneath that trend line again. But also, if we get a little bit lighter reading, maybe it's not so bad. Maybe rates continue to get better. But this is a good time to pull the trigger. So for buyers, the difference between now and a month ago, yes, there's less competition now. There's more inventory. Let's start going through some of this stuff. Okay, so today was a wild ride in the markets. Crypto's been getting crushed. For sure, a bear market confirmed on crypto, by the way. I've completely changed the lines on my chart. The blue is the downtrend that we're in the middle of right now. This yellow band is the support band. Got to stay in there. Breaks below that, it's going to get really, really ugly. So prepare your cash if you're a buyer. Bonds, the 10-year under 3% now slipped under. Remember when I was saying, hey, at 3%, that's going to attract buyers. Look, it did. That's what's happening. Oil has taken a few hits, now under $100. Gold down in the low 1800s again. That's kind of a quick overview. The CPI reading tomorrow is the big one. That's the one that's going to, kind of tell us, are we still headed in this checked direction of just higher inflation with no end in sight? Or is it easing a little bit? Even if it just decelerates, even if we see higher inflation, but it decelerates, that would be really good for the market. Starting to see stuff like this, and I've been talking a lot about sentiment. Sentiment is the key. You're going to start seeing a lot of negative stuff in the media. This is all done on purpose. A lot of it's paid for. The purpose is to make sure that you are doing the wrong things, that you are doing what they want you to do. They don't want you to buy houses because they want them. And you're going to see here in a couple minutes some of these headlines what they're driving people to do. Pay no attention to it. Do the opposite of what these headlines say. I'm telling you right now, if you want to make money, that's the way to do it. If you want to make the right decisions. Do you want to make the right decisions?
Yeah!
Okay, then. So housing supply is finally improving as high prices and rising rates weigh on sales. This looks like a positive headline, but then the dagger. High prices and rising rates. They weigh on sales. And this is all true. It is. It's slowing people down a little bit. It's slowing the market down a little bit. How else do you think the market's going to slow down? That's what it looks like. You see a little rise in inventory. You see, little less buyers, a little less competition. This is all good for buyers, by the way. This is not really worth reading overall, but there is some cool data points in here. I'm not going to run through it right now, but I'll put the link in the description. This one is interesting. As mortgage rates spike, credit scores are more crucial than ever. Yes. Also, the concept of shopping for your loan is probably more crucial than ever. The concept of trying to figure out, hey, am I getting the best deal? Where is there a deal? It's amazing to me, even as a broker, someone who has access to dozens of banks, how just I have to take the extra steps to do searching to find the best deal for my clients myself. So that's probably as important as anything else, because it's not just, we have a bad credit score, so we should get a bad deal.
Hated it!
That's not how it's supposed to work. Just because you have low credit or have a something that isn't perfect doesn't mean you automatically are screwed. There's certain banks that will specialize in that. There's certain opportunities that you might be able to capitalize on still. So yeah, shopping is really what matters. Credit scores have been king for a long time, but honestly, the credit scores I'm seeing have less impact. Like it used to be like there was a big difference between a 720 and like a 780 on the conventional side. Now it's pretty much the same. If you're above 640 on FHA or VA, you're really in the sweet spot. Like having an 800 credit score isn't going to help you that much. Now, it will help a little bit, but not very much, not that much. 640 is a crucial number, though, for the FHA and VA. 680 is a big number for conventional. Even though you can do conventionals down to 620, you really want to be above 680. All right, so that's the straight, just fact spitting on that. Here's some of the negative articles that are coming in. Household debt nears $16 trillion despite rising rates and inflation. So we see, big debt. This is one of the things they're going to point to. A lot of the people who are bearish on everything, they're going to say, hey, people are out of control with debt. Out of control. And you know what? They might be right. They might be right. Maybe we do have too much debt. Maybe there's too much debt going on out there. But remember, to keep a healthy economy chugging along, you need debt. You need people borrowing money to spend it. You need people borrowing money to invest it, and then paying it. The key being that they're paying it back. That's the key. They're paying it back with interest, and everybody's winning, right? So this isn't necessarily negative. It is true. This is something they're going to start talking about a lot. Oh, did I mention on the same day? Consumer credit card debt and annual percentage rates are heading to an all-time high. So they're now showing you that credit card debt's headed to an all-time high, which, by the way, we've pretty much been making all-time highs with student loan debt, credit card debt, auto loan debt, mortgage debt every year for as long as I can remember. But they always whip these headlines out like it's some breaking news. I don't know why, the obsession with that, but, Brighter's looking for a headline. Here you go. Consumer credit card debt, annual percentage rates are headed to an all-time high. Well, that's not great news. It's not. But it also isn't that much news, to be honest. Okay. So this is one thing I love to see here. So Bob Pisani's probably as legit as they come, but notice the headline. I guarantee you he didn't write it. Traders search for signs of a bottom as stocks dive. Why investors should proceed with caution. telling investors to proceed with caution. This is very lightly worded, but it is indicative of what I expect more pain in these markets. And remember when we chronicled how in the first quarter there was only one disclosure from a member of Congress about being short the stocks, but in this quarter, we believe when we finally get the filings, which doesn't happen until the beginning of next quarter, so it's a July, we'll find out that a bunch of people are short. I think that big money is trying to make money on that side of the trade, and they want to scare us as much as possible so that they can buy/cover at a lower price, and that's what's going on. I did cover some of my NASDAQ short yesterday for big profits, and that's really just so I can buy more Bitcoin, to be honest. All right, this is really, so Netflix has been crushed. Hopefully you aren't the type of person who just bought Netflix and put it on the shelf and forgot about it, because your portfolio has been murdered if that's the case. But Netflix, I don't see the value proposition really declining here. It's just the growth that's an issue. They're talking about introducing ads. This would be a crusher. Like if they actually do that, then really sell your Netflix. Crackdown on password sharing should have happened a long time ago. But ads, guys, we're paying for these services and they're putting ads. And this one thing I don't understand about Hulu. How do I pay you $50 a month or whatever it is, and I have to watch ads? This is terrible. So that's just the old TV model. Why is it like that? That doesn't make any sense to me. I think these guys need to really think carefully about this from a streaming service standpoint. If you're trying to compete Netflix, that is not the way to do it. Look out below. Inflation outlook for consumers falls from record high. Okay. So inflation outlook falls. So inflation falling is good. This is good. And this is what I've been talking about when we're looking at, could this be a bottom? Could this be the bottoming process? Could we be in a situation where we're trying to create a rounded bottom here? And that would really be the best thing for bonds. And you could see there's room for that to happen. Either that, or the other thing that could happen is an inverse head and shoulders. Here's the head right here. Okay. Here's the shoulder over here. If we kind of dance up here and then come back over here, we have a nice rounded bottom with a reverse head and shoulders. And that could be just an amazing sign that bond prices are going higher, interest rates are going lower. What if that happens? I'm not saying it's going to. I don't even think it's the likely scenario, but look at how it's setting up. It definitely could. It definitely could. The worst could be behind us. Are you ready for that? What if that's the case? What if that's the case? What happens next? Well, if that happens, this will be the shortest bear market in history. Stocks will go nuts. Cryptos will go nuts. Everything will go nuts. Rates drop again. Real estate would go nuts. All that is possible. It's all possible. I'm not saying it's going to happen, but it is possible. It's on the table. We can't just sit here and go, oh, bear market, everything's getting crushed. Real estate's getting crushed. Things are too expensive. You have to understand that one of the things that's also happening is we have record household wealth in this country. Record household wealth by a long shot. So don't forget about that. If you think all those people are going to take all their money and just stick it in the bank account where they're getting 0.34% or whatever, I disagree. I don't think so. I think people are going to put money to work one way or the other. And a lot of the people that I know who are very, very, let's just say big dollar folks.
All we want to do is pump you up.
They're pulling the trigger right here. They're pulling the trigger mostly on real estate. And so you're going to have a really hard time arguing with me on stage about how real estate doesn't make sense right here. But notice the opportunity in the market that we're in. Buyers, there's less of them out there. I'm talking to agents who are like, I don't have an offer on my listing. It's been on the market for multiple days or a week. You know, that's opportunity for a buyer knocking, is it not? Isn't that what we've been like waiting and hoping for the opportunity for buyers to be able to go, you know what? You listed for 700. How about 675? You have no other offers. What does the agent has to present it? There's opportunities out there right now for buyers. Take a look. Listen, there's obviously a lot of bidding wars still going on. Like I said, we're losing a deal a day. You know, we're losing an offer a day, probably on average, where it's like, okay, we're in the mix and they went with someone else. So that's definitely still happening, but it's not happening on as many properties. So there was a point in time where literally every single home that sold, it was a bidding war. Every single one. Didn't matter where it was. Didn't matter what condition. There were multiple people who wanted it. That's not the case anymore. And that's a good thing for buyers. So let's not forget that. And rates improving is a good thing. So, we're seeing the VA rates in the mid fours, for conforming balance, in the high fours, getting closer to the mid fours for the high balance, even 4.625 today for high balance VA. FHA mid fours, 4.5% for high balance. You're seeing some jumbo rates. Quoted a jumbo rate today on a purchase, 3.825% for a 7.6 arm. So the rates aren't as bad as we're making it seem, but they are higher than they were a month ago or 2 months ago or 3 months ago. And I saw something on, I think it was CNBC or maybe it was Fox Business. It was a YouTube video segment, and they were comparing a year ago. So 1 year ago, rates were on average a little bit below 3%, and now they're more like low 5%. So we've seen a 1.5% increase year over year. Shoot, we've seen more than that on the average just this year. I thought it was funny that they were putting that as like just this year. We've seen an increase. Sorry, it was 2.5% almost. Just this year, we've seen the 2%, almost a 2.5% increase since January 1st. So yes, that's a lot for the market to handle. And yes, I'm expecting a massive, massive refinance boom a year from now, maybe 18 months from now. All these people who are getting 5.25%, 5.5%, 4.75%, all of those people are going to refinance. They are. They're going to end up in a better spot. That's what's going to happen. So is there a lot to be worried about if you're invested in real estate? Is there a lot to be worried about if you work in real estate? No, just understand that the market it's adjusting. It's taking in what's happening, and it's just a slow process. It doesn't happen immediately. But right now is an opportune time for buyers who want to not be in a bidding war. If you're a buyer who got out because you're like, I don't want the bidding war, can't do it. Can't take the pain. Can't take the process every week and doing the same thing, writing offers, not getting it, writing offers, not getting it. This is a better position. This is a better market for you right now. So take advantage of that. Give me a call, shoot me a text. If you have questions, email as well. Hope this is helpful for you guys. Have a great day, and I'll see you again soon.